We had to draw down the strategic petroleum reserve. We had to put ourselves into what is kind of a near recession so far, and yet oil's still at the level that it is. So imagine what it is if we were to have another economic cycle without any sort of drawdown in strategic petroleum reserves or things like that. So I think that's probably what's not getting the coverage that it should. And the problem is that if it's not getting the coverage that it should, people aren't really working on fixing it as fast as they probably should be and taking the steps they have to do to give us, 5-year, 10-year, 15-year energy security.
Since early 2022, the Federal Reserve has been doing quantitative tightening, meaning is gradually destroying base money to rein in price inflation. This sucks liquidity out of the financial system and is usually negative for financial asset performance. According to financial analyst Lyn Alden, the Fed hit a speed bump in March 2023 due to the banking crisis, where the Federal Reserve had to provide loans to banks even as the Federal Reserve continued to destroy base money. They gave liquidity to the financial system with one hand while continuing to pull it out with the other, and the result was a net increase in liquidity, at least for a while. However, since late September 2022, the Treasury General account has been drawing down as well. Unlike the Federal Reserve balance sheet, a drawdown in the Treasury General account is positive for financial system liquidity. When it draws down, it pushes liquidity back into the system that it had previously removed. They're now getting quite low compared to their desired target, absent a debt ceiling issue of $500 billion. Since September 2022, overall domestic liquidity has been rather flat as the Federal Reserve and Treasury Department effectively offset each other. Risk assets have generally followed suit. Let us now get into the video as Lyn Alden throws more light on the present financial situation starting from the trending bank crisis. As you watch, make sure to like, subscribe, and turn on notifications.
Compared to 2008, so 2008 was a big credit problem, and that was like a gigantic private debt bubble unraveling. This one is obviously more of a duration and liquidity and interest rate type of challenge. And so this one's actually fully within the realm of policymaker control. So it's as bad or as easy as they want it to be relative to the other things they're trying to optimize for, which is primarily inflation, right? So at any time, if they were to cut rates and provide liquidity, the banks are fine. To the extent that they want to, keep optimizing for inflation, then some of the weaker banks are more vulnerable to problems. So that's actually what the key difference is they really have the tools to address this one pretty easily, should they decide to. And so I think it's gonna be. I think the worst is probably behind us. It's kind of famous last words, but to the extent that it does get worse, they have the tools to then shift back and maybe let inflation run her hot while stabilizing the banking system. So they have a bunch of tools on their plate to be able to handle that. I would still be very careful of small banks. I'd be very careful of kind of the lower end of the regional banks, any sort of highly specialized bank. I'd be careful with banks that have a lot of commercial real estate exposure unless you understand that book very, very high detail. Um, I'm not too worried about kind of the global foreign banks too much, outside of the ones that are always in trouble. And I'm not too worried about say, the top 10 banks, generally, in the US. And so I think this is more specific and it's more controllable. And it's really about, basically, if you go back in history, right, how do you come off the zero bound? That's actually a really hard problem for policymakers to do. If you have old interest rates for zero for a long time, how do you eventually get out of that? Because the problem is that when interest rates are zero, you build up so much debt in the system that if you raise rates, it causes a massive problem. And the last time we were in this situation was actually coming out of the 1940s. They after that Great Depression, they eventually had inflation because they did so much fiscal. It was obviously war related, but they did a lot of fiscal. They created a lot of inflation. They inflated a lot of debt away, and they eventually wanted to come off of that zero bound. And back then, their policy was to let inflation run hot and to come off the zero bound gradually. This time, they're taking the opposite approach, where they jacked interest rates up from like 0 to 5% in a little over a year, and so that kind of more ham-fisted approach has led to more bank instability. And they can always walk that back. They can slow it down. They can pause for a period of time, or they can, if they decide to, they can keep jacking that up. And so I think the policymakers going forward are going to balance between that inflation and financial stability kind of set of mandates. And investors obviously have to work around what they think policymakers are going to do there. But I think generally, with so many people talking about it, with so many policymakers looking at the problem, I think it's containable. And I think the thing that people aren't talking about is the thing that they were all talking about last year, which is energy and commodities. I think a lot of people have assumed that that's just fixed now. That we're completely done with any of our energy or commodity problems forever. It's kind of like last year's news. And while I don't really have an opinion on the next 6 months, like I don't, it really depends on again what policymakers do. I mean, if you slow the economy enough, then energy and commodities tend not to be a problem. But I think the issue is the next time they try to have a growth cycle. Let's call it the purchasing managers index. The next time you have a big upswing in the purchasing managers index or, you know, economic reacceleration in various forms, however you want to measure it, I think it's likely to come with another wave of inflation because some of the key drivers of inflation, even though they've been suppressed, have not really been fixed at their root level.
According to Alden, we've indeed been in that sideways liquidity situation, and the bank failures gave us a mild boost in liquidity in March. In a couple of months, however, we're set to enter that next phase, a potential negative double whammy for liquidity. Once the debt ceiling is resolved, the Treasury will be legally able to increase its general account back to its target level, which is negative for liquidity when it happens, as the Federal Reserve continues to pull liquidity out of the system, which is also negative for liquidity. The problem, however, is that bank cash levels as a percentage of bank assets are at pretty low levels in the post-2008 regulatory environment, especially for small banks. Sucking $500 billion of liquidity out of bank reserves to refill the Treasury general account might not be tenable and would likely be negative for financial assets.
And so I think the inflation wave hit harder and faster than they thought. And then it became the number one political issue. If you looked at polls at the time, inflation was the biggest thing. And so the Fed had to basically understand that the models were wrong, and that as much as they would have liked to have let inflation run hot for a period of time, it became so hot so quickly that they had to change into it. And, I think the second mistake then was trying to do everything right away. Basically, instead of just accepting there's a mistake now and you can fix it over time, it was like, let's turn on a dime and go from 0 to 5% rates, which when you have that much debt in the system and you're coming off of that low of a level, you're going to break a lot of things. And instead of letting that policy kind of like take its time to go through the economy, allowing refinancings to happen over time, they kind of just rammed it all through at once. And I think we're probably still going to be dealing with those side effects for quite a while. I don't think we're done dealing with the side effects. And I think the final point I'll make there is that when you hear Jay Powell talk, he's mostly referring to the 1970s. He's referring to Paul Volcker. He's comparing himself to Paul Volcker essentially. And I think the challenge is that the inflation dynamics we're seeing today and recently are more like the 1940s, which is that, in the 1970s, inflation really had two big components. One was obviously the supply side, like oil limitations, right? So domestic oil production in the United States peaked in 1970, and after like 100 years of going up, it rolled over conventional oil production, and so became more reliant on imports, and therefore we had all those geopolitical challenges and supply shocks and things like that. But number two, you had a demographic surge. The baby boomers were entering their home buying years. And so you had a lot of lending driven money supply growth. That was basically the peak period of US domestic bank lending. So you did have some money creation from fiscal stimulus, basically the guns and butter policy. But the majority of money creation was coming from banks. And therefore, the act of one, fixing the supply side through geopolitical means, and two, trying to tighten monetary policy did do a lot to quell inflation. Whereas 1940s, we had just as high inflation. Actually, the year-over-year figure was higher in the 1940s, but the average for the decade was around the same. Um, and the difference was that banks were not lending back then. That was not from excessive bank lending. Money creation was not coming from banks. It was coming from very large monetized fiscal stimulus, which was obviously war related. But a lot of that war related spending was domestic. You were building manufacturing facilities. You were getting commodities. The GIs came home, there was the GI Bill that sent 8 million of them to college and technical school and then subsidized their mortgages. Basically, that's a domestic stimulus, a fiscal stimulus. And so you had this huge money supply growth monetized by the central bank and the broader banking system. And so, very big surge in broad money, quite inflationary. Um, and rates don't really affect that. Like rising rates doesn't really affect how much the government's going to spend. And if anything, it actually makes them have larger deficits because they're paying higher interest on their debts, and that's adding to the deficit and actually contributing to money supply growth as you take money supply growth out from elsewhere. And so I think basically the dynamic we're facing now is that inflation is going to be a rolling concern as long as fiscal deficits are very, very large, and as long as we have supply constraints on the commodity side.
Economist Peter Stalling says the current banking crisis is already larger than the turmoil witnessed about 15 years ago, and it's far from over. Stalling says fallout in the banking sector has now eclipsed the global financial crisis of 2008 in terms of assets wiped out. The Economist believes the collapse of the First Republic and others is likely just the tip of the iceberg. Using the 2008 banking turmoil as a reference, Stalin predicts that hundreds of banks will go under in the next 12 months as the economy feels the wrath of the Federal Reserve's aggressive interest rate hikes over the past year. What's scary here is that going by 2008, the early collapses are only the beginning, the screaming prelude to an extinction-level culling of banks crawling off to die. In raw numbers, the 25 U.S. banks that collapsed in 2008 were followed by a drumbeat totaling 440 banks in the following 4 years. That's 110 banks per year compared to 2 per year pre-crisis. So we haven't even begun to see what's coming. The background problem is that the U.S. government is running very large deficits. The U.S. federal government ran a $1.1 trillion deficit over the past 6 months and will continue to run large deficits going forward. The Federal Reserve is currently a net seller of treasuries. Most commercial banks aren't buying treasuries, and even the foreign sector in aggregate isn't currently buying treasuries. Eventually, this post-debt ceiling liquidity cliff will likely be resolved by policy changes. However, none of them are easy. Someone needs to buy a lot of treasuries, and the question is who. If you enjoyed the video, make sure to drop your comments, give us a like, subscribe, and don't forget to turn on notifications. Thanks for watching.